Today, we're going to share with you 3 ways to lower your Medicare cost in retirement. Hi, I'm Brad Lineberger, president of Seaside Wealth Management, where we help people plan for and implement retirement strategies just like this. We work with a select group of people, and because we can't help everybody, we love to shoot videos like this to educate as many people as we can. So 3 ways to help keep your Medicare costs lower in retirement. It all comes down to your taxable income. The higher your income, the more you're going to have to pay in premium for Medicare. And so how it works is Medicare Part B is you pay a small monthly amount each month, and currently it's around $170 a month. And that's for your doctor visits and utilizing care from your doctor. Medicare Part A is free, so there's no cost there. That's not something you don't have to pay for. But then Medicare Part D is your prescription drug plan, and you pay $40 per month for that prescription drug plan. Now, the higher your income, the larger the premium that you're going to have to pay for Medicare. And what this is called is IRMAA, which is Income Related Monthly Adjustment Amount. That's a mouthful. IRMAA, IRMAA. And let me assure you, IRMAA is not your friend, because the higher your income, the more you have to pay in surcharge or premium on your Medicare. So the way to keep IRMAA lower and keep more money in your pocket is to keep your tax bill lower in retirement. And here's 3 ways to do that. Number 1, ROTH conversions. So every dollar that you take out of a traditional IRA is taxed at ordinary income, which thus can have an impact on IRMAA, can make the Medicare premium more expensive. So by doing ROTH conversions and starting to shift that tax burden out of a taxable bucket, the IRA, into a tax-free bucket, the ROTH, this is a wonderful way to keep the tax bill lower in retirement and keep the IRMAA premium down. We like to do this during your gap years, which are the years between when you retire and age 72, when required minimum distributions kick on. And when those RMDs kick on, it starts at a little bit less than 4% per year, but then it increases over time so that your required minimum distributions get to be rather large later on in life. And subsequently, your tax bill gets to be rather large. And then the ripple effect is your IRMAA premiums get to be rather large as well. It's a triple whammy. So the way to combat that is do ROTH conversions in your gap years. Now, a way to help do that leads to our second point, the second way to keep your Medicare premiums lower. Delay your Social Security benefit and consider delaying it as long as you can. Certainly, while you're doing the ROTH conversion strategy, by not having the Social Security income, that's just less income on your tax return, so you can convert more dollars, which will help you down the road. And also by delaying Social Security, it can be delayed all the way until age 70. Keep in mind that at least 15% of your Social Security benefit will always be tax-free. And I say at least because there is a chance that that all of your benefit could be tax-free. It just depends on your living expenses and how much income you need. For many folks, they can't live on just Social Security alone, or their lifestyle requires their income to be a little bit higher. So that's why I say at least 15% of your Social Security benefit will be tax-free, perhaps more. And then the third way to keep the Medicare costs lower, keep the IRMAA surcharge lower, is be really wise and careful about when you realize large gains in your taxable investments. So whether that's your primary residence or your rental properties or concentrated stock positions, or maybe it's a low cost basis with large embedded gains inside of your taxable brokerage account or your trust account. Anytime you're realizing these sorts of gains and have large capital gains, that can then flow through to your tax return and subsequently increase that IRMAA premium again. So Medicare does a 2-year look back period where they're looking back at the last 2 years of your tax returns to determine what the IRMAA surcharge should be. And so if there's a large sale of a capital sale or large asset with large gains, on that tax return, that could drive up the IRMAA. So 3 ways to keep it lower: Roth conversions in the gap years, delay Social Security until age 70, and really time the sale of your taxable assets very carefully so as not to impact Medicare. This can be really complex, and there's a lot of parts to navigate this. If you have questions or concerns or simply want help on your journey, don't hesitate to reach out. We're happy to help. And if you like this content, be sure to subscribe to our YouTube channel and we'll send you more.